SoFi just pulled off a massive 55% rally in 2024, on top of doubling in 23. So if you missed that run, you might be thinking, did I just lose my chance? That's a fair question. But here's the crazy part. For most of 24, SoFi was in the red. Nobody was betting on it. Analysts were skeptical. The stock looked like it was running out of steam. And then, almost overnight, it flipped, going from struggling fintech to one of the hottest stocks on the market. So what changed? And more importantly, is there still time to buy before the next big run up? The short answer, I believe there is. And in this video, I'm going to break down exactly why SoFi isn't done yet and why I believe what's coming will make the last 2 years look like a warm-up. As always, not financial advice. Do your own research. Here's my opinions. Smash that like and let's go. SoFi has spent years positioning itself as the Swiss Army knife of personal finance. Banking, loans, credit cards, investments, all in one sleek, user-friendly app. But what really makes it different, unlike most fintech companies that rely on partnerships with traditional banks, SoFi took a huge leap in 22 and secured its own bank charter. That changed everything. Now, instead of borrowing money at higher rates from third-party banks, SoFi can lend on its own terms, keeping more profit in-house. It also means lower costs, higher margins, and a competitive edge that most fintechs simply don't have. But here's where it gets really interesting. See, while SoFi started as a student loan company, it's evolved into a full-fledged financial ecosystem. The company calls it a financial service productivity loop. That's a fancy way of saying that once you join SoFi for one product, they're gonna hook you in with better rates and perks and encouraging you to use all their services. Now, maybe you start with the student loan, then move to a checking account, then a credit card, and eventually an investment account. This strategy is working. SoFi isn't just adding new users, it's sticky users who actually engage with multiple products. And that's a massive deal for long-term profitability. Now, let's get to the real reason SoFi's stock is still a buy, and why the next phase of its growth is just getting started. It really is. SoFi's explosive growth. The numbers that matter. It's one thing to say SoFi is growing, but the numbers prove it. The company isn't gaining users, it's actually locking them into its ecosystem at an insane rate. By the end of 24, SoFi reported 10.1 million total members, an increase of 785,000 users in just the last quarter. You call that steady growth? I'd call it domination. To put it in perspective, SoFi is adding more new members in one quarter than some traditional banks add an entire year. Here's what I think separates them from the rest. These aren't inactive accounts. Unlike other platforms that lure you in with promotions, SoFi members actively engage with multiple products. The company's cross-selling strategy is working exactly as planned. Hook them in with a service and then get them to use 2, 3, or 4. This engagement is driving serious revenue per user, or RPU, growth. Back in 2013, the average revenue per product was $53. Fast forward to 24, that number is now $81. That means SoFi isn't just getting more customers, it's making more money per customer, which is exactly what you want to see in a company that's scaling toward profitability. And speaking of revenue, the real game changer is SoFi's non-lending business. See, while lending's always been SoFi's, it's their bread and butter. Its financial services and tech platform segments are exploding, growing 64% year over year. In fact, just a year ago, these segments made up 39% of SoFi's total revenue. Today, it's pushing 50%. Let me put that plainly for you. SoFi is successfully transitioning from being just a lending company to a full-fledged financial powerhouse. And with interest rates coming down, student loan refinancing demand surging, we could be looking at SoFi's biggest growth wave yet. Let's break down exactly why that is. Why SoFi's growth is about to accelerate. So SoFi's expansion is already impressive, but the real upside comes from what's happening next. See, the company's positioned to capitalize on two massive tailwinds: falling interest rates and the return of student loan refinancing demand, both of which could supercharge its business in 2025. Let's start with interest rates. After an aggressive rate hiking cycle in 22 and 23, the Fed has finally started cutting rates, and that's a huge deal for SoFi. Lower interest rates directly benefit fintech lenders because it makes borrowing cheaper and refinancing more attractive. The lower rates go, the more people people look for better loan deals, and SoFi is perfectly positioned to scoop them up. Then there's the student loan refinancing boom. That's about to hit. See, with Trump back in office and his administration rolling back student loan forgiveness, millions of borrowers are scrambling for refinancing options. And guess who dominates that space? Ding, 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 SoFi, of course. This is a repeat of 23 when student loan payments restarted and SoFi saw a massive surge in refinancing apps. Except this time, interest rates are falling, which means double demand. So that's a 1-2 punch of catalysts that could push SoFi's revenue and profitability through the roof, to the moon! And the proof is already in the numbers. SoFi's financial service segment, which includes banking, credit cards, investing, it generated $100 million in profit in 24. Now that might not sound huge yet, but compared to just 3.3 million in 23, you see that trajectory. This isn't slow gradual growth, this is exponential scaling. Put all this together, lower rates, student loan refinancing boom, and a rapidly growing non-lending business, SoFi is positioned to thrive. And for investors, that means the biggest gains could still be ahead. Now, let's get into what this means for SoFi's stock price. Should you buy SoFi stock right now? Well, that's always your decision. But with everything we've covered, the explosive user growth, the booming financial service segment, the tailwinds from lower interest rates, the big question is it still a good time to buy? So let's be real. SoFi's stock has already had an incredible run, surging over 55% in 2024 and more than doubling in 23. But here's what most people don't realize. Despite that run, SoFi is still undervalued when you compare it to traditional banks and fintech competitors. Take a look at SoFi's price to scale, or PS ratio, a key metric for valuing growth companies. Right now, it sits around 3.5x, while competitors like PayPal trade at 4.2, and some traditional banks at 5x or higher. That tells us one thing: even after this rally, Wall Street still hasn't fully caught up to SoFi's growth potential. And then there's the student loan refinancing boom, like I said. With Trump's administration cutting back student loan forgiveness, millions of borrowers are desperate for better loan options. And SoFi is the go-to lender in this space. But let's talk about volatility, because that's what keeps people on the sidelines. SoFi is a high growth stock, and stocks like these don't move in a straight line. It's already had multiple dips, drops, and rebounds. And if you're expecting a smooth ride, you're in the wrong game. Here's the strategy: buy on pullbacks, hold for the long term. The short-term traders will come and go, but SoFi's business is getting stronger every quarter, and the market will eventually catch up. So where could this stock go? Analysts have price targets of $30 and more by 25, but with the momentum it's building, even that could be conservative. Now, let's talk about SoFi's secret weapon, the thing most people aren't paying attention to that could send this stock even higher. SoFi's secret weapon? The AWS of fintech. Everyone knows SoFi for its loans, banking, investing services. But what most investors overlook is the company's hidden moneymaker, its technology platform. See, while other fintechs are struggling to just become banks, SoFi is out here building the infrastructure that powers banks. And that's a game changer. Through its Galileo and Technisys platforms, SoFi is absolutely serving its customers. But it's also selling the pick and shovels that other financial institutions need to run their businesses. This is the same playbook that turned Amazon Web Services, or AWS, into a $100 billion plus powerhouse. And SoFi is executing it in fintech. Just look at the numbers. While lending remains SoFi's biggest revenue driver, its non-lending segment, like banking and tech services, are growing much faster. In fact, these segments now make up nearly half of SoFi's total revenue, up from just 39% a year ago. That's important because it means SoFi isn't just another loan company. It's building an entire financial ecosystem that's scalable, diversified, and highly profitable. Think about it this way. While interest rates affect lending, SoFi's tech and financial services keep generating consistent revenue, regardless of what the Fed does. That makes it way more resilient than other fintechs that rely entirely on loans to make money. And here's what most people are missing. SoFi is positioning itself to dominate digital banking infrastructure in the same way AWS dominated cloud computing. That means as more banks and fintechs turn to digital solutions, SoFi profits from their growth, whether or not they're direct competitors. This isn't some far-off fantasy dream, it's already happening. And with SoFi's CEO Anthony Noto calling Galileo the AWS of fintech, it's clear the company is thinking much bigger than just banking and loans. So while the market's still fixated on SoFi's lending business, the real long-term growth story is happening behind the scenes. Now, let's put everything together and talk about what this really means for investors. What's next for SoFi? The real opportunity. SoFi's recent growth has been impressive, but here's the real question. Is it already priced in, or is there still room to run? To answer that, let's talk valuation, upcoming catalysts, and the biggest risk investors need to watch. Right now, SoFi trades at around 16 times forward earnings, which for a high growth fintech isn't crazy. Compare that to legacy banks like JP Morgan or Bank of America, which trade at 10 to 12x. You might think SoFi is expensive, but here's the difference. SoFi is growing at 30% a year, while traditional banks are lucky to grow 5 to 7%. The market is slowly waking up to this, but not fast enough. So what could change? Number one, profitability kicking in. SoFi was unprofitable for years, which scared off a lot of investors. But by Q4 of 24, it finally flipped net income positive. Not just adjusted EBITDA, but actual GAAP profitability. That's huge because many institutional investors have rules against buying money-losing companies. Now that SoFi is making real profits, it's officially on their radar. Number two, interest rate cuts and loan refinancing boom. We've already seen one rate cut, and the Fed is expecting 2 or 3 more in 25. Lower rates equal huge refinancing demand. SoFi loan origination already hit a record $5.3 billion last quarter. If rates keep dropping, that number could explode even higher. Number three, institutional investors still on the sidelines. Retail investors have driven a lot of SoFi's rally, but big money hasn't fully moved in yet. Hedge funds and pension funds tend to wait until a stock shows sustained profitability before loading up. And SoFi just crossed that line, meaning we could see serious institutional buying in the coming quarters. But what about the risks? Well, every stock has risks, and ignoring them is a mistake. SoFi's biggest challenge, number one, competition from big banks and other fintechs. Sure, SoFi is growing fast, but let's be real. Big banks aren't just going to roll over and let them win. Traditional banks still dominate deposits and lending. And with fintech, companies like Chime, Robinhood, and even Apple, they're stepping up their financial services. SoFi needs to keep innovating to stay ahead. Stock-based compensation, or SBC dilution. SoFi pays employees a lot in stock, which increases the share count over time. If they don't manage it well, it could limit how much the stock price rises. However, now that the company is profitable, they can afford to use more cash instead of stock, which should help keep dilution under control. A potential recession could slow growth. If the economy slows down, people might borrow less, and loan defaults could rise. SoFi has done well managing the risk so far, but it's something to keep an eye on. So the final verdict. Is it still a buy? Well, SoFi's past growth has been impressive, but its future potential is even bigger. With GAAP profitability now in place, rate cuts driving new loan demand, and institutional investors starting to take notice, SoFi could be one of the biggest fintech success stories in the next decade. Short term, the stock could still be volatile, but long term, SoFi could be over $50 by 26 if they keep executing. So if you're investing in SoFi, zoom out. Don't get shaken by short-term moves. The foundation seems to be in place, and the next wave of growth could be the biggest one yet. SoFi's future, how high can it go? We've broken down SoFi's massive growth, why profitability is a game changer, and the big catalyst that could send the stock even higher. Now let's talk price targets, because if you're watching this, you're probably wondering how much upside is actually left. Well, analysts are all over the place with their prediction. Some have a $15 price target, others calling for $30 or more. But let's cut through the noise and look at the numbers. Right now, SoFi is valued at around 4.5 times its projected 2025 revenue. That might sound high compared to traditional banks, but again, SoFi isn't a traditional bank. It's growing at over 30% a year while legacy banks are barely moving. If SoFi keeps this pace, it could hit $3 billion in revenue by 26. At that point, even a conservative price to sales ratio of 5 to 6x would put SoFi between $35 to $50 per share, which means we could still see another 2 to 3x from here. And that's just assuming SoFi keeps growing at its current pace. If the financial service platform explodes the way management expects, if refinancing volumes surge with low rates, if institutional investors pile in, the upside could be even bigger. Should you buy now or wait? Let's be real. No stock moves in a straight line. Even if SoFi is headed to 50 bucks, there will be drops, corrections, and profit taking along the way. If you're looking for a perfect entry point, you'll probably never pull the trigger. The best strategy? Dollar cost average, or DCA. Buying in small chunks over time helps you ride out short-term volatility while still benefiting from long-term gains. So if SoFi dips, can you lower your average cost? If it keeps running, you've already got skin in the game. The bottom line, this stock isn't done yet. The fundamentals are strong, the catalysts are lining up, and SoFi is no longer just a speculative fintech. It's a profitable company with serious momentum. So the real question is, will you be watching from the sidelines, or will you be in before SoFi's next breakout? If you found this video helpful, and I know you did, don't forget to like, subscribe, and drop a comment where you see SoFi's price going next. Let's talk about it. I will see you in the next video, and you keep living your life to the fullest. Till next time, peace.